Welcome back to another in the series on money and retirement. A lot of people do not like to even think about income taxes, but being in a position to plan for them can save you a lot of money and is very important, particularly as we enter retirement. We have a straightforward agenda. Going to give you an overview of the current federal tax code because understanding how it actually works, whether or not you prepare your own taxes, this is super helpful to understanding the basics of tax planning and the various strategies I'm going to share today. The next topic, we'll talk about how different account types are taxed. It makes a big difference. Some are taxed quite heavily, some are taxed fairly lightly. Then we'll get into some tax management strategies using a case study. And then we're going to address the topic of asset location and portfolio longevity, how to make your money last as long as you do. So in 2017, the Tax Cut and Jobs Act was introduced, and this was significantly different from the tax code as it existed before. It introduced new tax brackets. I'm going to show those to you so you understand what the brackets are for 2022. It also introduced new tax rates. And one of the big effects is that there's a lot more money that is taxed at lower income tax rates. So for many people, this was quite beneficial. The other big change was that new higher standard deduction amounts were introduced. Much higher standard deductions than had been true in the past, but a lot of deductible items for people who itemize their tax deductions disappeared or were income limited. This pushed a lot more people into using the standard deduction. This worked out great for some people. It didn't work out as well for others. Another major change is that personal and dependent exemptions were eliminated, and most people really didn't see this or understand that this was the case until they started a new job and had to figure out their withholding. You know how they make you fill out the W-9, how many exemptions. This is much more a pay-as-you-go type of tax code. And so by eliminating the exemptions, because you could claim 6 of them and have very little tax withheld from your paycheck and decide to pay your tax bill on April 16th, that is more or less over. So you can do, I think it's up to 3, and you can have extra tax withheld if that's in your interest, but you can't game it in the same way that people used to. Another major change was the cap on state and local income taxes. This is called the SALT cap. SALT standing for state and local taxes. And what this is was an effort to change the tax implications, or the tax impact really, for people who lived in states with high state income taxes and high property taxes. Because it used to be, before 2018, when Tax Cut and Jobs Act went into effect, that if you had a huge property tax bill and you paid a lot of taxes, income taxes to the state, you could deduct all of that on your 1040, April 15th, and not pay as much to the federal government. So that was eliminated, and a cap, you can deduct up to $10,000 combined of property and local and state taxes. This again, great for some people because they didn't pay much in local tax, but harmful for other people who live in high income tax states, high property tax states. In fact, a lot of people really lost the ability to itemize their deductions and ended up using the standard. So, and paying higher income tax. The elimination of many tax deductions and credit mean that fewer people itemize their tax deductions, and some retired seniors have much bigger tax bills than was true before this tax bill passed. So just a quick picture of the tax form that you submitted last year for 2021 to show some important concepts. So we understand the flow of the income tax form and how it's calculated, because these terms over here in the margin, adjusted gross income and taxable income, are really important to understand to do effective tax planning and protect yourself and protect your income from taxes you may not need to pay. So when tax preparers and CPAs talk about income taxes, you will hear them refer to above the line items. And above the line meaning that first you take gross income from all sources during the year. Then you subtract adjustments, and we're going to get into what these adjustments might be. After you've made that adjustment, you now have what's called adjusted gross income. Most people are familiar with the term adjusted gross income because when you look at various income-related benefits, you will hear people refer to, if you have AGI within this number and that number, you are eligible, for example, to make a fully deductible IRA contribution. That's one of the ways it's used. If you are looking at certain credits, the lifetime learning credit, the American Opportunities credit, that is keyed to adjusted gross income. And so you would be familiar with AGI from those discussions. The next place where CPAs love to talk about taxes and the planning they can do and how they can save you on your tax bill are what are called below the line adjustments. So there you take this adjusted gross income and you subtract deductions. And these deductions will be either the standard deduction or itemized deduction. And so these are the numbers reflected on last year's form. I believe they will be the same for the 2022 form, which is not yet final. So you'll know where to look for this if somebody says, what was your adjusted gross income last year? That's a conversation you might have, for example, if you were working with New York State of Health to pick out a health plan and wanted to know if you were eligible for the insurance subsidy, the credit, which is based on your income for the prior year. Now, where do you make the adjustments? There's actually a form that accompanies your 1040 called Schedule 1. And this form is for all adjustments. It's your sources of additional income and then reductions in that income for certain expenses or losses. So you'll see, for example, that you'd use it to show income for a home business, for example, or a sole proprietorship business, or even an LLC business. You would do that on your Schedule C and take the number at the bottom and insert that on Schedule 1. When it comes to adjustments to income, which are reducing it, IRA contributions are disclosed on this form. Other items that you'll see are health savings account contributions, and then various other different types of expenses that can actually reduce your taxable income. So good to know about this form. It's worth a look even before you make that appointment with your tax preparer, because they might not know to ask you about all of this. You know, whether you had jury pay, whether you had a little hobby that produced an income, for example, or that you've made a variety of these different deductible expenses. We get to the standard deduction, which under age 65 for 2022 is $12,950. If you're over age 65, you get to add another $1,350. So your standard deduction is $14,700. These numbers are simply doubled if you are married filing jointly. Now, some good news, and you may have seen this in the paper, because of inflation, not exactly our friend, but because of inflation, in 2023, the standard deductions are going to be higher. So that's good news. The other impact is that when we look at the income tax brackets, all of them will be adjusted higher as well, which means that we may be subject to or may be eligible for not only a higher standard deduction, but more of our income may fall into a lower tax bracket. So when we talk about the standard deduction, here's how it works. There's another category for head of household, but that's fairly specific. And with itemized deductions, again, the most common itemized deductions are $10,000, which is the limit on state and local taxes, medical expenses in excess of 7.5% of that adjusted gross income. There's another reference to that term. Mortgage interest up to $750,000 is deductible. PMI, private mortgage insurance, and if you're not familiar with that, it's for people who purchase a property and don't put the standard 20% down. The bank will often insist that they pay PMI to the bank, ensuring that that their mortgage payments will continue. Excuse me. And then lastly, charitable contributions. You can only deduct charitable contributions if you itemize your deductions. The ability to deduct $300 as a single person or $600 as a married filing jointly, that was true during COVID. That has gone away again. So you have to be able to itemize in order to deduct your charitable contributions. Here we're looking at the actual tax brackets and tax rates. Now the brackets refer to this span of income for single people, this span of income for married filing jointly people. And it means that if you have incomes, say, of $30,000, you would pay 10% up to $10,275 of income, and 12% from there to your income, total income of $35,000. So when the taxes are calculated, depending on where you fall, you may find yourself in the 12% bracket, the 22% bracket, the 24% bracket. Excuse me. Now, one thing to know about the current tax code is that there's greatly preferential tax rates for long-term capital gains. Where do you get long-term capital gains? From your investment account, from the sale of a property, real estate, sale of a business, sale of other types of assets. If it has gone up in value as you've owned it, when you sell it, and you've owned that asset for longer than 1 year, your tax on that sale for the gain is subject to capital gains tax rates. They are highly preferential. Notice here, and this was a big change under the Tax Cut and Jobs Act, there's a significant amount of gain, excuse me, taxed at zero, depending on how much income you have for the year. You'll see that's $41,000 for single people, and for married filing jointly, exactly double that. And I'm going to show you how that works. The capital gains tax sits on top of the income tax. And I'm going to walk you through it because it's a little bit hard to understand until you see it visually, I think. 20%, this is a giant amount of capital gain when you think about it. And you'll see that with under 459,000, it's taxed at 20%. So look at the difference between capital gains tax rates and brackets and income tax rates and brackets, because I'm going to return to this preferential treatment later on in the presentation. Now, this is probably one of the best visuals I have found for explaining how long-term capital gains stack on top of ordinary income as we calculate what your total tax bill will be. And I'll walk you through it so that it's clear. Here's an individual who has $60,000 in ordinary income from a job, from interest on savings, from taxable dividends. Adds up to $60,000. They also happen to have $60,000 in capital gains. So those two are, set separately, but I'm going to, again, bring you through the calculations. So with a regular income, first what happens is you take the standard deduction. Now, I will say up front that this image was produced in 2019, so you're going to recognize that that's not the 2021 married filing jointly standard deduction. It's a little bit lower. So you slice off the standard deduction, and this individual or this married couple has $35,600 taxed as ordinary income. Goes through a couple of brackets. As I showed you before, their total tax bill, $3,884. Now what happens? Okay, so you've got this $35,600. This capital gain sits on top of it like a hat. Okay, that's how to think of that. So you'll notice that in calculating their total tax bill, you've got ordinary income, 10%, 12% for the next bracket. So that takes care of this $35,000 in ordinary income. Then we figure out the capital gain tax. They're married filing jointly. So remember how I showed you that currently it would be $83,000 would be taxed at zero. In 2019, it was about $78,000 that was taxed at zero. So they've got $60,000. They have $35,000 in income. This sits on top. So they've got a chunk subject to 0% capital gains tax. They have some, a very modest portion, subject to 15% capital gains tax. And so you have this total tax bill of $38,804 plus $25,028, total tax bill of $6,412 on total income of $95,600. So remarkable how having capital gain income, because it's taxed at a lower rate, is very beneficial. So knowing that, having our little walk through the tax code and how this really works, comes down to paying our taxes. Let's talk about how different account types are taxed, because it's important to keep this in mind as we envision how we're going to draw money down and pay for our expenses in retirement. Every dollar you take out of your 401k or 403b account, traditional IRA, or a fixed or variable annuity is taxed as ordinary income. Now, the fixed and variable annuity, the earnings are taxed as ordinary income. And that is if it's a non-qualified. So let me step back. A little bit more complicated than I intended. If this is an IRA annuity, all of these work the same way. They're all taxed as ordinary income. Any dollar you take out of it. If you have what's called a non-qualified fixed annuity, meaning it's not an IRA, you just happen to buy it at the bank, you have a John Hancock fixed annuity paying you 4%, you put money into it, it's after tax money out of your savings account, you take money out of it, some of that money will be return of your principal, known as basis, and some of it will be interest. The earnings are taxed as ordinary income. And every year you're going to get a form from the insurance company called a 5498 that tells you how much of that is subject to tax. A variable annuity, if you're not familiar with these, this is similar to buying mutual funds inside a tax-deferred annuity contract. So it gives you the ability to not necessarily earn a fixed rate of return, but to invest your money in hope of a higher return. They work the same way in terms of taxation. You have basis, and when you take money out, some of your in a non-qualified annuity, some of it is return of premium, some of it is your earnings. Only the earnings are taxed as ordinary income. From the payments you might receive, income you receive in retirement, your pension is fully taxable. And your deferred compensation plan, which is an alternative type of savings account, savings plan that is often offered by the government and by not-for-profits. So it's sort of like a shadow 403B for many people. Many of them look and work the same way. They have the same limits as a 403B or in terms of how much you can contribute. The one difference that it can be material is that they're not subject to the 10% excise tax for taking money out before age 59 and a half. But otherwise, the money you take out is definitely taxable. Now, taxable brokerage accounts and directly held mutual funds. These are where we hold our investments. And when I refer to directly held mutual funds, some of us have been around long enough to have held Dreyfus funds. Remember those? And Fidelity from way, way, way back. They were all directly held. You didn't necessarily have them inside a brokerage account with other investments. You got a statement and it was just about your Dreyfus fund. More and more, these investment companies are having them in the brokerage accounts. That's just reflects consolidation in the investment industry over the past many decades. It's also easier for the companies, and when I say the companies, I'm talking about Charles Schwab, Fidelity, Vanguard. It's easier for them to do the consolidated tax reporting in a brokerage account rather than doing individual funds. So when you own a taxable brokerage account, you've got all sorts of things in it. You might have some individual stocks, some individual bonds, bunch of funds. Maybe you've got some low cost, highly diversified index funds. Maybe you have some exchange traded funds. Because this is a taxable brokerage account, anytime those investments spit out any interest or any ordinary dividends, it is taxed at regular income tax rates. So capital gains distributions that are considered short term, that means you've only purchased this investment within the last 6 months, you haven't owned it for more than a year. These are going to, any of those capital gain distributions from that fund or from that stock are going to be taxed as ordinary income. Capital gains treatment, qualified dividends. Now, a qualified dividend, and anytime somebody uses the word qualified, it comes from the IRS, and it means this preferential tax treatment. And a qualified dividend is paid out on an investment that you've owned for more than 12 months. So if you've owned shares in IBM for decades, likely you'll look and see that 90% of what you receive in the year is considered qualified. Maybe there's some, it's kind of hard to figure out the formula, a little opaque. You might have some that are considered short-term that are taxed at more ordinary income rates. But this is one of the benefits of holding investments for a long time, is that if you have them for longer than a year, they move into this preferential tax treatment for these dividend distributions. And for any capital gain distributions, you've held funds for year after year, those two, you're going to have some capital gain distributions. If it's an actively managed portfolio, you have less control over this, meaning that the portfolio manager is making the decisions, what to buy, what to hold, what to sell. And if they're buying and selling within a 12-month year, they are going to generate short-term capital gains. and you will have taxable capital gains and regular income tax on it. For things that are held longer, it'll be a capital gain distribution. Many people, just to give you an example, myself included, last year, you remember that as we approach the end of the year, the market seemed to be on fire. It was going great guns, and a lot of portfolio managers, even in index funds, sold positions, generated significant long-term capital gains way late in the year. And a lot of people, myself included, did not know the magnitude of some of those gains and had a big surprise tax bill as a consequence. Normally, these had been very tax efficient funds, but positions that they had held for a long time and needed to sell for a variety of reasons. We have to go through the prospectus to understand why they were selling. Some of these, because they've been held so long and had such built up gains inside, when they sold the positions, this was a huge capital gain distribution. Again, at preferential tax rates, but it still stinks if you don't know in enough time to be able to do some planning ahead of it. Another type of account that people have in retirement that they often envision as a source of income, even fund money, are life insurance policies. And here I'm obviously talking about whole life, universal life, what's called permanent life insurance, not term. Term expires, doesn't have any cash buildup. When you have a permanent life insurance policy, you will get a statement, typically once a year, that will show you the status of the insurance policy and how much cash value that policy has. This is value in excess of the death benefit. And this is for a variable universal life, the result of the returns on the investments inside the contract. If it's a universal life policy, it's the interest that has grown and added to this cash value. When you surrender your contract, this will also be on your statement. If you're still within the surrender period, and the surrender period is the period during which, if you decide to cash in the contract, they're going to haircut the cash value before they return your money. They're going to keep some of it. And the whole idea is that they want you to hold on to this policy and keep paying your premiums. If you're beyond the surrender period, then the cash surrender value is going to be equal to the cash value of the contract. And when you take it out, this is considered a tax-free return of premiums paid. Another way that people like to use permanent life insurance is to take loans out of the contract. You can take it out for whatever reason, and whether you pay it back or not, so long as you don't take out so much cash that you basically, strip the policy and defund it, effectively closing it. So long as your loan leaves some money in the contract that it stays in force, that cash value loan is tax-free. Okay. So again, we see people doing this who are doing estate planning and who might want to access this cash in a year when, or it's either they're doing estate planning or they need to access cash in a year where they do not want to add to their income tax bill. This can be a source of income. Let's look at Social Security. This is an income stream that most Americans expect to receive, and there's often confusion on how it is taxed. And you can see that if you're single, married, filing jointly, you have to earn a fairly modest total income in order for this to receive any tax, real tax breaks. And this is federal taxes. In New York, Social Security is not taxed by state income tax. That's true in many states, by the way. So if you have income less than $34,000, it's taxed at a 50% rate. If you have income, if you're married filing jointly, at or below $44,000, it's taxed at 50%. But As is true for many people, if your income is over 35K or 44K, that income tax profile, it's now 85% taxable. So better than 100%, but still, considerable as we look at our income in retirement and our total tax bill. Reminders on Roth IRAs and Roth 401k, 403b accounts. These are separate beasts. The tax code treats them very differently. Now, if you have a Roth IRA, withdrawals from that account are tax-free, provided you're over age 59 and a half, and the account has been owned for 5 years. Okay, here it says 4+, it has to be on record for 5 years. If before you've owned that account for 5 years, maybe you are a young person, you need some extra money, you're a little tight on things, you can withdraw your contributions for any reason without tax consequence, but you cannot take out the earnings. So it can be a great backup savings account, which is how I encourage young people, or why I encourage young people to start this. It can be a great place for savings, excess savings that can be tapped for tuition bills, things like that. It's got a lot of flexibility, but if you want to take the earnings out tax-free, you have to be over age 59 and a half and have owned the account for 5 years. Now, I mentioned that Roth IRAs and Roth 401k and 403b accounts are separate beasts. They're treated very differently in the IRS tax code. We can contribute money into the Roth 401k. It comes out of our paychecks after tax. So that's fabulous. What you have to remember is that so long as it's in the 401k or 403b, that Roth money, that after-tax money, is subject to 401k and 403b tax rules, which means that they are subject to RMDs, required minimum distributions, which kick in now at age 72. So what does that mean? That means that if you are contributing, which I encourage people to do, to a Roth side of your 401k or 403b, when you retired, or certainly before you turn 72, roll it out into a standalone Roth IRA, because only then is it going to be tax-free. And it's actually in your interest, since you have to hold this for 5 years, to do it well before you're about to turn 72, so that when you want money, you can take out both your contributions and your earnings tax-free. I think it would be helpful to show you some tax planning strategies here using Tony Taxpayer as a case study. This gentleman is a retired Department of Education employee. He's currently 74. So what do we know about 74-year-olds? They have to take RMDs. His tax filing status is single. So he does receive Social Security, which is taxed at 85%, and that number here is $26,500. He does receive a nice pension, $37,400. His total IRA and 403b account balance December 31st of last year was $900,000 based on his age, and that balance value, his RMD amount for the year, is $36,360. He also has some taxable dividends and interest adding up to $5,400. So his adjusted gross income is $105,660. We're missing a zero. Oh, here it is. It's down here. Remember from our last presentation that if he's earning this much money, he is going to be subject to IRMA, Income-Related Medicare Adjustment Amount. So this means that rather than $170.10 a year this year, it's going to go down a little bit next year, he is going to pay an additional $60 a month for the same coverage. So that is calculated again using adjusted gross income. He's eligible for the standard deduction. He doesn't have enough itemizable deductions otherwise. So his taxable income is $90,961. Now, pre-retirement, he made a very good income, $160,000 a year. So he had been with the DOE for a while, came in after a successful career doing consulting, working for himself, in and out of the private sector. So he accumulated a pension. He also, while he was working, contributed the required 3% to the New York teachers' retirement system pension system. Comes automatically out of the paycheck based on what your annual income is and what tier you're in. He also contributed the max to his 403B plan, trying to shelter some of that income, reduce his tax bill. He also contributed 6% to the 457B plan, known at the DOE as the DCP. So he was able to shelter a fair amount of his income. So he had lower taxable income, really, if you look at it, a lower tax bite while he was working. So what could he do to reduce some of this tax annoyance, some of this tax cost now? Well, I mentioned this last class that we would talk about this particular strategy, which is a qualified life annuity contract, known most typically as a QLAC. And what a qualified life annuity contract is an annuity, an insurance contract. It's a fixed annuity contract. It'll pay a stated rate of interest that you buy using a rollover out of an IRA or that, out of an IRA into this contract. So what does that do? So how does the process actually works? The cap that anyone can put in is $145,000. What you would do is you would roll $145,000 out of the 403B. He's retired, so he can do this at any time, into an IRA, a rollover IRA, and from the rollover IRA, fund the QLAC contract. What are the benefits of doing this? Well, for this gentleman, it reduces the balance subject to annual required minimum distribution withdrawals. Turns out he doesn't need all of this taxable income. It's starting to just sort of cum up in his savings account, and he realized that he's paying taxes that that he finds really annoying. The way QLACs are designed is after you've done this rollover, which is non-taxable, from the 403B into the IRA into the QLAC, it simply compounds. It earns a return stated in your contract every year, and then payments begin in 10 years. So if you buy it at 74, in 10 years, he could start payments at 84. Those payments would last for life. Those payments are taxed as ordinary income. What this does is provide what's called longevity insurance, meaning that it's income he cannot outlive. And when you buy these, you work with an agent who can get illustrations from several different insurance companies because the rates and terms will vary. And some of them have the ability to start taking payments in 5 years, which people like having that option. Even if they intend to hold it for 10, it's nice to have access to the money in 5 years. Some of them are generous in how they allow you to leave money to beneficiaries. So they're all a little bit different. And the crediting rate, the interest rate that you could earn, will change almost daily, depending on the carrier's interpretation of the trajectory of interest rates and their underwriting and their perception of mortality risk. How many people will live to 105, for example? So they're very interesting products. They do offer people who need this, who want this longevity insurance and to reduce their retirement funds from current RMDs and taxes. They are a solution designed to do that. Another strategy to reduce that RMD would be to elect a qualified charitable distribution. And what that means is that when he is informed in January how much he will have to take out for 2023 to meet his RMD requirement, he says, okay, I don't want to take the whole 36,630, if that's the number. I want to designate my first RMD withdrawal to be sent directly to the not-for-profit or charity of my choice. He could send it to his alma mater. He could send it to PSS. He could send it to a huge variety of qualified charities. So long as that amount goes directly to that entity, that not-for-profit, and it's the first withdrawal taken, it is not counted as taxable income. So here he has done something good, something he was intending to do anyway, give money to a charity of his choice, but he's also reduced his taxable income as a consequence of doing that. So now let's turn to asset location and portfolio longevity. And what I mean by this is that it's important to consider the tax profile of the accounts in which we hold assets. We have tax-deferred accounts. These will shelter dividends and bond interest from ordinary income tax rates. So they are optimal locations for actively managed mutual funds and ETFs that generate a lot of dividends, for example. Things that will be taxed at ordinary income tax rates. I'm sorry, yes, because you're sheltering them by putting them into the tax-deferred accounts. For taxable investment accounts, and typically these are brokerage accounts, these are optimal for assets subject to the preferential capital gains tax rates. Remember those examples we looked at, and the fact that for many, you could pay zero up to a certain amount of income. That's pretty attractive. So the types of assets that will either be sold at a capital gain or will generate long-term capital gains are great for taxable brokerage accounts. So if you had an S&P 500 index fund, that could be a good candidate, or an ETF, individual stocks and individual bonds, things where if it has a big increase, you could sell it for a capital gain that will be taxed at the capital gain rate. You want to have fewer things that generate big dividend or interest distributions in your taxable investment accounts. So for taxable investment accounts, I have a typo here. This should be your non-taxable investment accounts. So for example, your Roth IRA is a great place to put your high-yielding stock or bond investments and growth investments. This is really a matter of how old are you, excuse me, and what is your investment time horizon. So, and that's true because if you have bond investments that are kicking off interest payments every month or every 6 months, and these are significant, and maybe you have either a high yielding stock or a dividend appreciation fund, these are very popular. Having them in a Roth IRA means that you're not going to pay income tax on these particular, on those distributions. So back to our friend, Tony Taxpayer. He has got an adjusted gross income that still exceeds the 91,000 to avoid the IRMA. So what can we do for him here? We've already reduced his RMDs. So you get, excuse me. See that that's significantly lower. Can we reduce this and get him under 91,000? Well, let's look and see what we can do. And to get this to 24,000 from 36,600, he did both the QLAC and the qualified charitable distribution strategies. Well, what he can do is what we were just talking about. First, he can enact some tax loss harvesting and asset relocating to make sure that he's got his dividend generating assets in a tax protected account. So what would make sense for him to do, it's December, is to look inside his taxable brokerage account where he's got some bonds and some bond ETFs that have long-term capital losses. Might as well harvest those. If interest rates keep going up, those losses are likely to only get bigger. And he sells some individual stocks and mutual funds that have some long-term capital gains. Those will cross each other out, and his capital losses wipe out the capital gains. And he's got $3,000 in excess losses. This excess loss will wipe out $3,000 in taxable income. So there he has solved his problem. He has gotten away from being subject to IRMA. And he's got a viable strategy there with tax loss harvesting. Now what he can do to make sure that he does not have lots of interest income subject to income tax next year is he's going to do some asset relocation. He sold out the bonds and bond funds in his taxable account. He's only got stocks and equity ETFs and index funds. We know that this is tax efficient. The account will generate some dividends, but most of these will be qualified because he's held these particular investments for a long time. So this account will now have a nice low tax profile until he sells something, and he will generate some long-term capital gains taxed at those preferential rates. In his traditional IRA or 403B plan, here is where he's going to reestablish his fixed income portfolio. So up here we have his asset allocation. He's got a 60-40 portfolio, 60% equity funds, 40% fixed income and cash equivalent. And by selling what he did, his bonds out of his taxable account, now he's at 70-30. That's way too aggressive for him. So what he'll do is he will sell some equity funds to create some cash inside either his IRA or 403B account, and then use that cash to buy some bonds and bond ETFs and restore his asset allocation. The dividends generated by these new holdings are not going to increase his tax bill going forward. He's only going to incur an income tax bill when he withdraws from these accounts. These types of accounts, again, are tax deferred and taxed as ordinary income when you make a withdrawal. So these are ways for Tony the taxpayer to manage his tax bill going forward. So here we have, I'm sorry that this is wrapped around here. We've lowered his taxable dividends and interest. And now we see that his IRMA, he doesn't have IRMA because he's under the 91,000. His adjusted gross income is 90,075. So the benefits of doing some asset reallocation are basically to enhance the potential longevity of your portfolio. And the basic premise is if you are paying less in taxes, you will have to sell less of your assets to pay them. So you hold on to more of your money, which can remain invested and stay and compound and help you have as much money as you need for the rest of your life. And so by opportunistically selling investment holdings subject to capital gains rather than tapping retirement accounts for needed funds, you can enjoy a lower income tax bill. This lower income tax bill requires that fewer assets or shares are sold to cover the tax bill and will increase how long the assets last. Lowering this tax bill and increasing your portfolio longevity in this manner is referred to as adding tax alpha. The idea that you can basically have more money by holding on to it and keeping it invested is alpha, higher returns, simply by doing some good tax planning. I have some bonus content here for our New York City seniors. Just want to make sure that you are aware of a program run by the Department of Finance called Senior Citizen Homeowners Exemption, or SHE. And it's for property owners, whether you own a condo or a co-op, age 65 and older. The SHE program offers a reduction in New York City real property taxes of 5% up to 50% of those taxes based on your income. Now, you know, as a property owner in New York City, if you live in a condo or co-op, that you see your property tax as part of your maintenance bill. So that's where you're going to see this benefit if you're approved. The household income cap is $58,399, but it is neither adjusted gross income or taxable income as defined by the IRS. I'm going to show you how it works, because more people are qualified than realize that they are. So it's more people need to know how the program really works. The SHE program does an income verification every other year, so makes it fairly simple. And you can do tax and income planning to make sure that you are under that $58,399 cap when you need to verify your income. The deadline to apply is March 15th. And if you are approved, your rebate will appear as a credit on your July 1st maintenance fee invoice. And if you get a big credit, you may see that your maintenance bill is zero for a couple of months and then resumes once you have exhausted that tax credit. So here's what people need to understand about SHE. Yes, when they are looking at income sources, they want 100% of your Social Security, not just the 85% that's taxed according to the IRS. They want to know all your dividends and all your capital gains, any gains from sales or exchanges, any payments you get from pension plans or private retirements. Here is the biggie. For IRAs and annuities, they don't want to know your RMD amount, how much you withdrew from either of these. They want to know, what did these accounts earn? Well, some years your IRA may have earned a lot. Some years, maybe even this one, it could be flat to down. So that could be a very modest number. So people who think because of their RMD income that they would never qualify for this plan, for this program, are mistaken, and they should really explore this. And then obviously salary and wages and all of these other traditional forms of income. So note number F, or letter F, then also understand the following. The New York City Department of Finance subtracts from your income the federal income taxes that you pay, your New York State and New York City income tax, your FICA if working, your Medicare or Advantage plan premiums. Whether or not you itemize your income taxes, when you go to apply for SHE, you just need a handy spreadsheet of all of your medical expenses for the past year as you do your application and as you verify your income. If you have a lot of out-of-pocket, you may not have had enough to claim a medical deduction and itemized your expenses, but they're not even asking you for 7.5% in excess of your AGI. It's every dollar that you spent on unreimbursed medical and prescription drug expenses. You make the list. You will add in your Medicare and Advantage plan premiums. This is an adjustment to the income that they're looking at, and hopefully this will get you under $58,399. So it does say down here, IRA distributions are not included, and certain other items, return of capital, etc. So as I said, many people don't realize that they're eligible for this program, and it's a great program, and it has helped a lot of people. It should be helping more people. So please spread the word. In summary, there are some tremendous benefits for doing some tax planning and understanding how the federal income and capital gains tax basics work is super important. Tax reduction strategies are different for working versus retired people. Retired people can't contribute to retirement accounts. And different types of investment accounts and different types of investments have very different tax implications. Asset location can help you pay less in taxes and make your money last. So I hope this has been helpful. I would be delighted to answer some questions now.
Thank you so much, Anthea. One thing that you've been asked to do is to put the title slide that shows your contact information up again. So
Okay.
if you could flip to that page, that would be great.
Sure.
It was the first, second, or third slide. Okay. And then I'm going to go through these questions
Sure.
in reverse order. So is she based on income from the current year or prior year?
So the people who are applying now, and I've coached a few people through it, are using income from 2021.
Okay.
Because most, and I have people who play it both ways. If 2021 was too much income, they're waiting to see if 2022 looks better.
Okay. This set of questions is based on Tony taxpayer. Why is he being taxed at 85% based on Social Security income, or is this based on total income? I think
the 85%, sure, the 85% of his Social Security is taxable because his income is higher than $34,000. His total income.
Okay, is it better to have Social Security take taxes out?
It is, it can help you if you don't have taxes withheld and you have other sources of untaxed income. For example, you've got a portfolio that generates a lot of dividends and capital gains. You're not paying taxes on that. The IRS will expect you to pay quarterly estimated taxes if you don't do any withholding. And so having taxes withheld from Social Security, most people kind of get managed into doing at least 10% for that reason.
Okay. Is it based on current income taxes or look back?
The withholding?
The Social Security income.
Oh, so this, whether or not you are taxed at 50% of your Social Security income or taxed at 85%, that's based on your total income from all sources.
Okay.
And then if you're when you're talking about withholding, you have to call the Social Security Administration or do it online and elect to have the withholding, and it will be going forward. They won't retroactively adjust.
Okay. This set of questions goes back to the very beginning. What is modified AGI?
Modified AGI, which is used by, for example, Medicare to determine your Medicare premium and whether you are subject to the income-related Medicare adjustment amount, that extra penalty premium. Modified means you add back any contributions you made into a retirement account, into an IRA. So they basically reverse all of those pre-tax contributions and they add it back to your income.
Okay, for standard deduction for married joint, will over 65 apply only if one person is over 65 or both husband and wife need to be above 65?
You get both. So if you have one person over 65, you get the additional $1,350. So you will have slightly less than the standard because the other person's under.
Okay. I've heard of something known as SPIA as an alternative to QLAC. What is an SPIA and how does it compare to a QLAC? Thank you.
Okay, so an SPIA and a QLAC are very different animals. The QLAC, think of that, the nickname for it is longevity insurance. A SPIA is a single premium immediate annuity. And what you do there, you take money, typically it's after-tax money, and you buy, although I believe you can do it with an IRA, you buy a contract, and the contract gives you either a monthly or semi-annual or annual payout for the rest of your life. So there is some similarity because a QLAC does become a series of payments after 10 years. The SPIA, the income starts immediately. And people do that who want the security of having a regular paycheck. They often refer to it as creating your own pension. Maybe you take $100,000, you buy a SPIA, now you're getting, $150 a month, whatever it is. The way SPIAs work, there are two very important components to the amount that you will get every month. One is how old are you when you buy it? The older you are, the more of the payout you will get. The other is where are interest rates? If interest rates are high, that is reflected in higher monthly payments if you pick the monthly. The SPIAs often come with what's called a period certain, and many people elect that. And the period certain means that, say you take $200,000 and you buy the SPIA, but you're worried, what happens if I die, I don't get all this money back, and my thought was I'd live to 95 and this would have been a great deal, but I die in 5 years. Why can't I have this go to somebody? So with a period certain, if you die within that first 10 years, 15 years, there is money. The rest of the payments that would have been made during those 10 years go to your named beneficiary.
Okay, and one final question. Are there types of taxpayers for whom a QLAC is particularly advantageous, such as with or without beneficiaries, with or without long-term care assurance, or LTCA?
So the great problem, the QLAC solves two problems. It is a way to reduce the qualified money, meaning retirement account money, that is going to be subject to RMDs. So looking at that as a solution, who needs that solution? People who work beyond regular retirement age. And there are situations where people work past 72. They're taking RMDs out of their IRA. They don't need this money, they're working. So being able to reduce their IRA by up to $145,000 may be beneficial. People who are working past age 72 typically feel that they have undersaved for retirement. So having that guaranteed income that's going to kick in 10 years is a pretty attractive feature as well. So that's really the design premise behind it. With the beneficiary, most people just viscerally don't like the idea that they could buy this and die before they get any benefit from it. So having the ability to add a beneficiary, meaning that some portion of the contract would go to the named beneficiary, just gives some peace of mind that somebody benefits from it.
Okay. Well, Anthea, thanks once again. Thank all of you for staying with us through this presentation. On January 26th in the new year, we'll be doing a deep dive into estate tax planning with Ron Fatula, and you can register for that class now on the Retire Ready site. Have a wonderful holiday, all of you, and hope to see you at some more Like You presentations.